Finance and technology continue to merge, streamlining roles and operations in banks. Robo-advisors, which do everything from taking clients' information to doing algorithm-based trading, first came onto the scene in 2010. Recently, I spoke with Paolo Sironi, IBM thought leader for wealth management and investment analytics, about how financial institutions are letting technology do the advising. Hi, Paolo. You've said that the development of robo-advisors has stemmed from increased banking regulations. Why is this?
Regulators have increased the transparency in terms of cost, so they have forced the wealth managers to look for solutions which are more convenient for the final investors, therefore they need technology to achieve that, as well as the capability to provide more added value.
And what are some examples of robo-advisors?
They are now robo in the sense they are primarily automated investment solutions that are rule-based. They are primarily a self-directed investment opportunity that onboards and engages individuals digitally. So one of the key features is that you go on your smartphone, you answer a set of questions, your proposed portfolios that may better fit your personality and your preferences, and from then onwards, the robo-advisor takes care of managing the money for you and providing automated reporting.
Do they also use AI to learn more about the client, their habits?
I think there's not enough AI at present inside the robo-advisors, but it's going to happen by looking and screening social media to engage and interact in the profiling phase. But also robo-advisors are solutions that can be used by the final advisors themselves to help them learning more about the customers and automatize part of the relationship.
Do they actually actively manage the portfolio, or does the client have to tell them these are the buying and selling points?
I would not call this active management. Let's say that there is autonomous rebalancing of the portfolio. Primarily, this is passive investment management.
Does this mean then that banks would be more interested in promoting goal-based investing as opposed to returns-based?
Regulators themselves are somehow forcing financial institutions to change their language and their marketing because performance cannot be sold effectively. And you need to invite people to invest for the longer period through the financial crisis or through market events to avoid that anxiety that typically leads investors to sell when the markets are low and buy when the markets are high. Therefore, linking the reasoning of investing to personal needs and goals might create that stickiness in the reasoning that helps you to justify the reasons why you invested the money, and therefore to be less exuberant and less exposed to the financial news.
You're saying that banks are now adopting gamification to help clients deal with the emotional roller coaster that they can sometimes be on investing.
Private banks in Europe, some of them take their ultra-high net worth customers to places like London to play war games. Basically, they want to do two things: help their customers to understand that they have to expect the unexpected, because you can manage the risks, but you cannot master uncertainty, and that is always around the corner. And secondly, they also learn from the customers which is their ambition and their fear into the future, so they can create scenarios that help them learn about how the customers would react given certain market conditions.
When you say expose them to scenarios, can you give me one example?
They could be personal scenarios because we change our life. We get married or not, we have children or not, we can have a better job, we can lose a job. Therefore, there are instabilities which affect our capability to keep investing the money the way we were doing before. A lot of people are saying more and more vocally that our personal behavior affects our portfolio returns much more than the performance of the benchmark.
How does robo-advising and gamification link to social media to give an institution more information about their clients?
By using customer insights, cognitive computing, the screens and scans of social media, you may be able to reach out to the customer exactly when a customer is thinking about buying a house, for example, and getting married, or engaging into transaction. So you can relate with the client digitally, sending notification or inviting him into a conversation, and you know that that conversation is more likely to be relevant. In a world where the margins are more and more compressed, financial advisors will have to take care of a higher number of customers, and it's very difficult for them to keep on personalizing the relationship by reaching out to the customers in a way that they can be relevant.
Now, with all this collection of big data, what role do human advisors play now?
There will be those that are happy to be only digital and self-directed, but there's a large majority of individuals that prefer to have a personal relationship.
So this doesn't mean that the robo-advisors will be taking the place of human advisors?
But we can consider the US an interesting example of Betterment, which is one of the first and most successful independent robo-advisors, was born around 2010 as a business-to-consumer type of solution. But 2 weeks ago, they announced that they started hiring financial advisors themselves because they realized that they are reaching to a larger number of customers which would be happy to receive their offers, but would prefer to talk to a financial advisor.
Where is Hong Kong in adopting robo-advisors and gamification?
Primarily, Hong Kong is the gateway for a lot of wealth coming from China mainland. And private banks are in means to service those customers and that money in better ways as it is growing very fast. So what we see is that there are not just business to consumers new solutions in the fintech space, but primarily business to business solutions. So fintech companies, young innovators, they want to provide the robot technologies to banks to help them improve the way they engage on board the relationship with these Chinese customers.
Do you think this is something that is going to be adopted quite quickly in China? I mean, they have managed to leapfrog everybody in e-commerce.
What banks need to learn is how to become themselves a platform where they bundle back a lot of services, making sure that customers don't have to move around and shop around to do what they need to do. That is why the biggest threat for financial institutions in South China might come from similar WeChat companies, and could be Facebook, could be Amazon, because they are already platform. So they might force banks to relegate to back office functions.
How far do you see banks streamlining their services and merging together with technology?
I think the cognitive bank is coming because banks are engaging a profound transformation. It is not easy because they are restructuring at the same time, so they need to do it in due time. They need to make sure from the board level that they manage the risks of new technologies and new business models and configurations.
Coming up on Money Magazine, how do web celebrities develop the talent to get jobs in the digisphere?